So with that, let's go ahead and get started because we do have a lot of information to cover in a short amount of time. Now, for those of you that may not be familiar with what the all-in-one loan is, I just want to go over a brief overview. The all-in-one loan was pioneered in 2005, so we've had about 17 years actually with this product in America. We've helped tens of thousands of homeowners across the country save tens of thousands, if not hundreds of thousands of dollars in mortgage interest. And the ability for this product to save these customers in time and money is the ability to put their money to work for them and not change spending habits. In fact, that's a theme you're going to hear me repeat several times on today's call because I really want to hit that point home. The easiest way to set someone up for success is to eliminate or reduce the amount of changes they have to make. And when it comes to the all-in-one loan, we don't want you to change a single thing with how you spend your money. Whatever it is you're doing today, please do tomorrow when you're in the all-in-one. And we'll get into more of that as the presentation goes along. Now, there are some things that as Americans and consumers, we all face. I could absolutely be considered an industry professional. I've been in the business since 2001, so definitely ample time being in the mortgage industry. But even though I'm what's considered an industry expert, I still face the same things that consumers face. Most of that being that we as consumers need to borrow money to purchase our properties. As average consumers, we don't just have hundreds of thousands of dollars or millions of dollars, depending on the area of the country that you live in, to just throw down and purchase a property outright. We have to finance them. In fact, 62% of the Americans today have a mortgage on their home. So if you think about it, there's a lot of us out there. We're in good company. That 62% of Americans equals about 60 million homes. So that's just another stat to put into context. Everybody has to deal with inflation, and inflation is cyclical. So even though we deal with it once doesn't necessarily mean we're not going to have to deal with it again. And we know during inflationary periods, our dollars don't go as far or wide as we would like them to be. And because of that, it does make it slightly more challenging at times to get approved for the financing that we need to obtain home ownership. So it's all somewhat linked and related. If you look at the types of products that we as consumers use when we go to purchase or finance our homes, we typically all gravitate towards the standard 30-year fixed rate mortgage. It's what we use, it's what our parents used, it's what our grandparents used. But interestingly enough, the amortized repayment schedule, the method by which we repay mortgages, and we're going to dive into that in just a second, but the amortized repayment schedule was introduced to the U.S. in 1938, and it hasn't been updated or innovated since. And since then, consumers gravitate towards that 30-year fixed rate mortgage. Now, I say that that's shocking. It's shocking that the way that we repay mortgages was introduced in 1938, but it hasn't undergone any type of innovation, any type of progression, any type of technological advance. And it begs the question, why? And it's because amortized repayment schedules are actually reliably profitable ways for banks to make money, so there is no motivation for them to change or update the way that an amortized repayment schedule works. Because of that, or that's probably one of the main reasons, our mortgage debt in the U.S. has exceeded $12.5 trillion. But let's put some context into that, or contrast, if you will, because we hear about the student loan debt very often. It comes up in many circles. In fact, some folks will refer to it as a national crisis. Well, the student loan debt is up around that $1.5 trillion mark. So we have a perceived national crisis of the student loan debt of $1.5 trillion. Yet when it comes to the over $12.5 trillion in mortgage debt we're in, there's absolutely nobody talking about how we as consumers can get out from underneath that debt. We know as consumers that the longer we remain in debt, the more costly that debt becomes, mostly due to the interest rates that we have to pay on those debts, whether that's a credit card, a car loan, if you will, a mortgage loan especially. The longer that you're in debt, the more that debt it costs you. And that actually can impede our financial growth in other areas. Mortgage interest takes a huge chunk of our dollars and gives that to the bank in interest. And I would almost guarantee that everybody on the phone today that has a mortgage, if you were able to carve out maybe 12, 15% of your monthly payment that doesn't go towards interest, actually goes towards the principal or other things, I think that you would more than likely agree that that would be good financially for the household. It's no secret that America is vastly underfunded for retirement. This is something that everybody faces. And there are many people that have many different types of solutions for that retirement debt, but really it just boils down to what we as consumers can save and plan for. So we have the student loan debt that's eating away at our income dollars. We have future retirement costs that are eating away at our income dollars. Some of us have aging parents that we have to think about what's next in store for them. That's also eating away at our income dollars. And if you think about, as a consumer, the largest asset you're likely to receive in life, well, that's your income dollars. And we rarely ever treat it that way. And we'll get more into detail on that in just a few moments. But think about the income dollars you earn. In fact, I would encourage all of you on today's call to think about the amount that you've earned over the last 5 to 10 years. Not what you've spent, just what you've earned. And chances are that's more than what you owe on your home. But again, as consumers, we've been conditioned and trained by the banks to not think of our income dollars in that fashion. Now, let's break down that amortizer payment schedule. Why did I say that this is a financial impediment to growing our wealth in other areas? Well, what we as consumers rarely ever take into consideration when the thought process of a mortgage repayment comes up is our own behavior as consumers when we overlay that with the amortizer payment schedule. So what you see on the screen, this graph, this represents a 30-year fixed rate mortgage. And every column represents a single year in that 30-year fixed rate. Now, statistically speaking, in the U.S., as consumers, we're going to refinance or recycle our debt every 5 to 7 years, just on average. Of course, there are some folks that will refinance at a quicker pace because they're chasing those low interest rates. Now, when you take a look at this graph on the screen, go ahead and count back 5 to 7 columns, which is going to represent the amount of time that you're in a traditional mortgage before you refinance. Now, in that amount of time, how much interest was paid versus principal balance reduced? We're paying the banks back 5, 6, 7, 8, 9 times the amount in interest than we're actually having applied towards our debt. And every time we refinance, we just start this back at square one. This is exactly why we say that low interest rates don't come with low interest cost. In fact, that's one of the biggest mortgage myths that's out there. Low interest rates do not equal low interest cost. Not when you factor in how we repay the mortgage, and not when you factor in our behavior as consumers. Now, to add a little bit of insult to injury, when it comes to a 30-year fixed rate mortgage or just any fixed mortgage at all, you typically cannot re-access any additional dollars that you pay into it. We're talking about prepaying. So if you decided you wanted to prepay an extra payment a month, maybe an extra payment throughout the year, maybe a few extra payments throughout the year, that's all well and good. The bank is generally not going to turn your money away. But if you had a financial emergency or burden arise that you needed those additional funds you paid towards your mortgage back, the bank isn't going to give them to you. You would be forced to refinance and cash out or sell your home to recoup the costs. So again, as an average consumer in America, prepaying my mortgage doesn't necessarily help me because I don't want to part with those dollars that I might need later on down the road. So again, this amortized payment schedule, not only is it outdated because it was introduced in 1938, but it's very rigid. It's not very flexible. It doesn't give us the type of choice and optionality that we would expect or like to have when it comes to paying down the largest debt we're likely to take on in our adult lives, which is our mortgage. And if you think about it, the mortgage is the largest debt that we carry through our adulthood. Usually from the mid to late 20s into the early 80s, we're holding on to a 30-year fixed rate mortgage. Now, there are exceptions to that rule. I'm not trying to make a blanket statement, but for the majority of Americans who have a mortgage, it's on a 30-year fixed rate mortgage, and that spans between the mid to late 20s into the early 80s. Now, when we take a look at the income dollars that we bring in, if your salary, you know exactly what that amount is. And if you have fluctuating income, you at least have an idea of the parameters of what your take home pay is going to be so that you can plan for it to a certain degree. But even with all of that being said, for the most part, the money we earn, it's already spent or earmarked before we receive it, because we have our lifestyles, we have our living expenses, and again, our future selves that we have to consider. We've got that student loans, we've got retirement, aging parents, what have you. We've got a lot of things that we're trying to budget and plan for. But 42% of our take-home pay every month is going towards mortgage. Sure, a portion of that does go towards principal, a large portion of that goes towards interest, and then we also have our taxes and insurance that we have to incorporate into that. But that doesn't leave us much left in that pie chart to change and update things on expenses not related to the mortgage. And I say that because being a consumer in America, we are inundated all day long with ways to save money. Now, before I go further, I am a proponent of saving money. But if you think about some of the advertisements you see on TV or the internet, they say, change your car insurance provider and save a few bucks. Change your cell phone provider, save a few bucks. And all of that's well and good. Again, I'm a proponent of saving money. But changing my car insurance provider isn't going to all of a sudden allow me to retire comfortably and early. And changing my cell phone provider isn't going to all of a sudden allow me to send my kids to college. Those are just areas where I have a little bit of playing room, where I can make some small adjustments, but the overall amount of savings isn't going to be substantially life-changing. And that's really where the all-in-one loan comes in when it comes to the ability to save money. Now, I'm just going to briefly go through an example because I think this might help for those folks that like math to kind of put things into perspective. If I was to purchase a home for $625,000, let's just say that I come into the transaction with $125,000. It's a pretty big chunk, but let's just assume. That means that I need to finance $500,000 of it. And if I got a 30-year fixed rate mortgage at 3%, I'm going to have to pay interest expense in the amount of over $258,000. So if I looked at that, now that 3% interest rate, which by consumers is perceived as a good deal, I'm ultimately going to end up paying over half the amount that I want to borrow back just in interest cost. And for the sake of argument, for those of you that think, oh, I'm not going to be in the loan that long, well, at the beginning part of the loan is really where you pay the bulk of interest cost. Because again, the longer they can delay that debt being paid off by 30 years, the higher that balance is. So even with a low interest rate, you're going to be charged higher in interest, even with a low rate. So I have to pay over half the amount that I want to borrow back in interest, assuming that I didn't refinance along the way. My interest as a percentage of principal is 52%. How many of you who've had transactions in the past was given an LE, and on that third page, you saw the amount of interest costs that were going to be associated with your loan, and there's a percentage right next to it. Oftentimes, people just really gloss over that. I mean, in all honesty, we could have $1 million listed as the interest expense, but from a consumer perspective, really all we're concerned about is that interest rate and that monthly payment, because from our perspective, we've been conditioned, again, to believe that that's the only factors that we have to look at when going to finance for a property. But 52% interest of principal, that's fairly high. And I find that it's easy to break this down when you break it down into dollar figures you can relate to. I personally can't relate to $258,000. I've never held that much cash in my hand before. So for me as a consumer to actually gauge and weigh how much I'm being charged in interest versus what I'm borrowing, I have to break it down into a dollar figure that I can relate to. And I typically like to use the tens of dollars. You could absolutely use the $100s of dollars if that works for you, but for me, I like $10. I've held a $10 bill in my hand before multiple times. So in this case, if I move the decimal point, for every $10 I borrowed in this loan, I had to pay back $5.20. So borrow 10, pay back 15.20. That's how you determine that interest to the percentage of principal. That means that my whole mortgage, once all said and done, I've paid back everything at the end of 30 years, I will have paid back over $758,000 in total payments. That's principal and interest. Now, for those of you that are on the phone today who have purchased property in the past, how many of you factored in the interest costs you were going to have to pay on your mortgage when you went to shop for the budget of your home? Chances are you didn't. because that's not something that we as consumers ever think about, although that is absolutely a real expense that we have to pay, especially once we have that amortized or payment schedule. And that ultimately becomes a 22% increase in the purchase price of the home. And increasing the home rate is the opposite of what we're trying to accomplish when we're going to pay off a mortgage. So this really good deal by perception, the low rate, low monthly payment, when you break it down mathematically speaking, this isn't that great of a deal for that customer because, again, they're paying 22% over what they purchased the property for. Now, for this particular example, we're going to break this down on how this particular customer with that 3% $500,000 loan amount, how they would fare against the all-in-one loan. Now, when we ran this scenario, this customer had been in this loan already for 8 months. So they had already been paying for 8 months that 3% on that 30-year fixed rate mortgage, and their monthly P&I or principal and interest payment was $2,137. So if we were to move this into the all-in-one loan, assuming no change to spending habits, budget, or lifestyle, including what they budget for the mortgage payment, so assuming that this customer is not going to make any changes at all whatsoever, just continue to do what they're doing today, tomorrow in the all-in-one loan, they in essence would be paid off in just over 10 years and save almost $90,000 in interest expense. So not only are they saving almost 20 years in time, they're also saving over or almost $90,000 in interest. Now, I could think of many things that the family or household could do with that $90,000 on top of almost 20 years not having that debt, but they could put those dollars towards improving the family and the household than just giving that to the bank in interest costs. So the all-in-one loan is a very powerful tool as long as you use it in the way it was intended. And the way it's intended is just for you to not make any changes to budget, lifestyle, or spending habits. It really is that easy. Now, what I do try to make sure customers are aware of when we have these calls is that the all-in-one loan is not how your parents mortgaged. It's not how your grandparents mortgaged. This is a new and innovative way for you as a consumer to actually start putting your money to work for you using the exact same strategies that banks are using today with our money. Now, if you wanted the easiest and simplest way to describe what the all-in-one loan is, it's home financing and personal banking combined. That's it. It really is that simple. Home financing and personal banking combined. But from our perspective as consumers, how in the heck does this ever make sense? So I'm going to ask a few questions, and I want you to answer these questions for yourselves. Do not put them in the Q&A section or the chat feature. You don't have to answer them in that fashion. Just answer them for yourselves and see if you can follow along with how this product works and how you can obtain those benefits as well. So every week, every other week, twice a month or monthly, whenever it is that you get paid, what is it that you're doing with your paycheck? Well, we're not burying them in the backyard in a jar, hopefully, and we're not putting them under our mattresses. We typically deposit our paychecks into our checking accounts, don't we? And oftentimes, we never even get a physical check anymore. It's just electronically deposited from our employer into our checking accounts. Okay, so that's been established. Our paychecks go into our checking accounts. My follow-up question to that would be, why are you using a checking account in the first place? Another extremely strange question. Obviously, we use checking accounts because they're safe, they're secure, and they're easily accessible. Any other reason you would use a checking account, and it's typically going to fall into one of those three categories. Now, in the all-in-one loan, your money stays safe, it stays secure, and it is 100% completely accessible to you via the methods you're already proficient at using. In fact, every all-in-one account comes with a Visa card that's also backed by the Star logo. So you can use it anywhere as a point-of-sale card that Visa is accepted, and you can use it at any ATM that the Star logo is accepted. You can order personal checks. You can sign up for online bill pay. You can link external accounts for easy ACH transfers. There's fraud protection features, there's auto alerts, you can add users. So again, the account looks and feels and functions exactly like a checking account does today. Only now there's that mechanism in place that's going to put your money to work for you. But what do I mean by that? In the all-in-one loan, every single time you make a deposit, doesn't matter the amount, doesn't matter the frequency. If you have standard AIO at 12 a.m., that deposit that you make is going to sweep into your all-in-one account at 12 a.m., and the entirety of it is going to go towards your mortgage. If you're a Texas homestead consumer, this is going to be a manual push, but you still have the ability to do that. So you deposit your income dollars and that goes towards your mortgage balance. Oftentimes, consumers will stop me right here and they'll say, Erin, hold on a second. I get that if I put my entire paycheck into this account, then at 12 a.m. it's going to sweep toward my mortgage, and my mortgage balance is going to reduce by the amount of my paycheck. I get that. But I've got groceries to buy. I've got bills to pay. I have extracurricular activities I need to put my kids into. This sounds good. I just can't see myself devoting my entire paycheck towards my mortgage. And this is where I agree with the customers 100% all day long. Yes, by all means, buy those groceries, pay those bills, put your kids in the activities. Whatever you're doing with your money today, do tomorrow in the all-in-one loan. And what this slide illustrates is that until you spend that money, it's going to stay in your account to keep your balance low, which is going to in turn keep your interest costs low. And that leads me to my next point. How are we calculating interest on this loan in the first place? Well, remember that the all-in-one loan does not have an amortized or payment schedule. We are never at any point in time going to predetermine a single cent in interest that you owe. The caveat with that is Texas Homestead, and we'll get into those details in a little bit, but still we're not going to, in advance of the loan closing, predetermine a single cent in interest that the customer owes, which would be you. Instead, what we do is we take a daily calculation. So you make that deposit, and that deposit is standard AIO. It pushes to the line of credit or the mortgage, and it reduces the balance by that amount. Texas Homestead, you decide how much you want to push to the line of credit. On that lower amount, every single day, we're going to take a daily calculation of the interest. We're going to take that new lower unpaid principal balance, times it by the interest rate, which is comprised of the index and the margin, and then we're going to divide by 365, and that becomes that day's interest cost. We don't charge it daily, we just calculate it daily. We do that calculation every single day of the month. Once the month is over, we're going to add up those daily calculations, and that becomes the interest portion that is due on the 21st of the following month. Standard AIO, it's deducted right off of the line. Texas Homestead, it's just due on the 21st as it normally would be for, or as it would be for any other mortgage, that it's due, that it has to be paid for. But you're always going to be paying interest in arrears in the all-in-one loan versus paying interest first like you would do in an amortized or payment schedule. Now, a couple things I want to make sure that you take away from this is that what we've done in this loan is we separated the principal payment from the interest payment. If you think about a traditional mortgage now, you make one payment each month, and it consists of principal and interest, and oftentimes taxes and insurance. You go to the next month, you make one payment that consists of principal and interest, taxes and insurance oftentimes. With the all-in-one loan, it's completely different. There's multiple payment instances. Every single deposit is, in essence, a principal balance reduction. We calculate interest on that lower amount. So as a consumer, based on how you interface with the account, you absolutely have some control over the interest costs that are calculated that become due the following month. So the following month is when the interest portion is either deducted or becomes due. So principal payments happen with every single deposit all month long. We settle up on interest the following month. You're paying your principal simply by simple interest, and the interest is collected or deducted in arrears. Again, no other lender in America today will take their interest second. They all take it first via that amortized or payment schedule. And this is really one of those major components that makes our product so much different than any other product that's out there. Oftentimes, this loan is confused by some industry professionals as being a HELOC alternative, and I like to clear the air on that with consumers because you can characteristically get into the differences between the all-in-one loan and a traditional HELOC, and really the only similarity that they'll have is that they're two-way instruments, meaning money comes in and money goes out. The way that they're structured is different. The way that interest is calculated is different. The way that you as a consumer interface with the account is different, amongst other things. So really, this isn't a fancy HELOC. This is different. That's why I usually reference it as a line of credit. But what does this structure look like? So for the first 10 years on standard AIO, you'll have the ability to draw back out up to the amount you were approved at. But how are we able to achieve a payoff at the end of 30 years if we're not going to require a structured payment? We do that by starting in year 11, month 1, so after year 10. Year 11, month 1, we're going to start to reduce the available credit line. And we reduce it by, the mathematical formula is the loan amount divided by 240, because there's 240 months in 20 years. So however you want to mathematically arrive at that. And oftentimes this is another spot where a consumer will interrupt me and they'll say, okay, Erin, hold on a second. Does this mean that I have to make an extra deposit into this account every month after year 10? And my answer is always the same, no. On average, our customers reach payoff anywhere between 8 to 12 years. That's the average. We have some folks that pay off in 2 to 3 and others that have been in the loan since 2005. So they're coming up on their 17-year anniversary. They're already in their credit limit reduction phase, but they continue to stay in the account because of the flexibility and optionality that it offers. Now, for my Texas Homestead folks, there is a slight difference with that I've alluded to during this presentation. We do still reduce the available credit line after year 10. So year 11 through year 30, we're going to reduce the available credit line. But something different happens in Texas for these homestead properties or principal residences. The legislation in Texas has different rules for primary residence that we have to abide by. One of them being that there has to be a fixed portion at the end of the term. So for the last 5 years, we're going to amortize the balance that's left, if there is any, over that 5 years, and the rate will be based on what the rate was in month 300. So month 300 sets the rate for month 301 through 360. Now, keep in mind that the payoff time is still on average 8 to 12 years. So if we were to take a look at how a consumer actually uses this loan by leveraging it and deleveraging it multiple times throughout their course of being in the loan, again, they're going to pay off well before that 25th year. But again, we do have that 5 years at the end for Texas homestead property. So it's just something to be mindful of. What you see on the screen is a perfect example of how a consumer has used this loan. And the interesting thing that happens once you reach a $0 balance on the mortgage side of things, as a consumer, you have two choices you can make. You can either close out the account and be mortgage free. Congratulations, you paid off your home. Or you can continue to pay the $60 annual fee that we waived the first year and have access to those available equity dollars to use at your discretion, again, if and when you choose. So just because you have your mortgage balance at zero, that doesn't mean that you have to close out the account, just the opposite. You can still access the available equity dollars that are there, again, for you to leverage and deleverage as you wish based on what the needs of the family and household are. This slide also really illustrates the multifaceted opportunities with this loan. One of the things I like to say is that it's as individualistic as the family or household that has it, because it can change and adapt based on what your financial goals are. You want to get into the loan because you want to be mortgage free or debt free, that's great. This loan's going to absolutely help get you there. But if 5 or 6 years down the line, you change your mind and you think, I think I want to purchase another property, or I want to invest in a business, you have the ability to do that. It's where you get to become the bank of you. And I know that's a very cheesy line, but it's a very accurate way of describing what this loan is and the possibilities that you have as a consumer that have it. There's 4 ways you get to save with this loan that you don't necessarily get to take advantage of with other products. And the main reason for that is because of that checking account component. Now, just for informational purposes, in case there's anybody on this call that wasn't already aware, the money that you have sitting in your checking account today is 100% being leveraged by the bank you have them parked at for their own purposes, whether that's for lending or building their wealth in other areas. They absolutely leverage the monies that are in the depository accounts to their benefit. And in the all-in-one loan, we say go ahead and you give that benefit to yourself. It's your money. You should be able to get that benefit versus the bank. So the first way you save is with every single deposit. It's going to reduce the balance by which the interest is calculated. And because we have a daily calculation, you get the benefit of it. The second way that you get to save is with the money you are going to spend anyway. In fact, I invite you to ask yourself these 3 questions. Do you buy all of the food that you need for the month in one day? Do you buy all the gas you need for the month in one day? Are all your bills due on the exact same day? Chances are you said no to all 3 of those questions, which is fair. Now, in the all-in-one loan, that money, until it's being spent, is keeping that balance low, which is keeping your interest costs low and keeping you liquid. So that money is still there for you to use if you intend to use it. It's just until you do, it's going to stay in your account and keep your balance low. The third way you save is by not changing spending habits, budget, or lifestyle. And I warned you that I was going to repeat that several times on today's call. Now, in the example that we had earlier, that customer was spending, I believe it was $2,100 on their principal and interest payment on that 30-year fixed rate mortgage at 3%. Now, in real life, that mortgage payment is being derived from the income dollars, right? You deposit your income dollars into your checking account, and then you write out a check or you set up a bill pay for your mortgage amount to go to that bank. The bank then splits it up between principal and interest, oftentimes taxes and insurance, and then you move on to the next month where you get paid, you make that payment, the same thing happens. Now, in the all-in-one loan, that mortgage payment is still being derived from your income dollars. That hasn't changed. But instead of depositing that into your checking account, you're now depositing that into your all-in-one account. And instead of having to send that mortgage payment to the bank to get split, you leave it deposited into your account all month long, keeping the balance low, keeping the interest cost low. So even though you're budgeting for that mortgage payment, you're not spending it. You're just leaving it deposited, which actually keeps it very liquid so that if you have an emergency arise, you have the access to use it. The fourth way you save is with your positive cash flow, the money that you weren't really going to spend that month anyway. That's going to sit in the account alongside your previous mortgage payment in the form of home equity dollars, and that's going to compound and grow as we go along, assuming, again, that you don't change spending habits, budget, or lifestyle. Now, I'm quickly going to just get into a few of the terms just so that you can understand some of the highlights that we have based on if you do standard AIO or if you go the Texas Homestead route. For standard AIO, remember there is no balloon payment or prepayment penalty. Those don't exist in the all-in-one loan, very similar to how they would in traditional financing or traditional HELOCs. In standard AIO, you have a 30-year draw. Yes, the availability will change after year 10 and slowly go down for an eventual payoff at 30 years. But for the full 30 years, you still have the access to draw on available equity dollars that are there. In contrast, a traditional HELOC will only give you 5 to 10 years that you can draw on that line, and then you're presented with a balloon payment or amortized repayment schedule, which as consumers we know we don't handle very well, but that's okay because in the all-in-one loan, it won't be there anyway. We can go up to $2 million without geographic limits, so this is a very good product for those of you in jumbo markets. We can do the all-in-one loan on a purchase and a refinance, and we can take all three occupancy types, primary residence, second home, and investment properties. But keep in mind, as a consumer, the majority of Americans usually can do really good with one AIO, maybe two AIOs. Remember that it's meant to be the main account of the household. So if you have one AIO loan, it works well. If you have two AIO loans, well, remember now your income is going to have to be split into two AIOs, and that could dilute the effectiveness of the product. So although you technically can have more than one AIO, make sure you go over that with your loan officer in the simulator because you might benefit from just having one loan that you leverage and deleverage versus having multiple AIOs. We can do SF or single family residences up to 4 units. Those are all going to be available property types. Now, some differences with Texas Homestead. So if we have any Texans on the line, I want to make sure that you're all aware of what those differences are. We do have that last 5 years of the term fixed to align with the A6 legislation laws in Texas for homestead properties. You do get a 25-year draw access because remember, we're fixing the last 5 years. Once it's fixed, you can't touch it. But you do have a 25-year draw as well. Again, purchase and refinances are okay to use. Texas Homestead applies to just primary or owner-occupied properties only. If you're in Texas and you have a second home or an investment property, then you're going to have standard AIO. Texas Homestead is strictly for those principal or primary residences only. Another difference with Texas Homestead is that the interest is not auto-drafted out of the line of credit automatically on the 21st of the following month. The 21st of the following month is when your interest costs are going to be due. So you want to make sure that those are paid either via the checking account or from an external account, but the 21st is when those interest costs will be due. And similar to your standard AIO counterparts, you're going to know about 21 days in advance what those interest costs are so that you can prepare for those. Primary residences in Texas are limited to an 80% LTV, and remember, there is no automatic sweep function. In Texas Homestead, it's a manual push-pull of those funds into the line of credit. Now let's get into the hot topic of interest rates. And I say this is a hot topic because if we're being honest with ourselves, what are the first 2 questions we ever ask an industry professional when the topic of mortgage financing comes up? What's my rate and what's my payment, right? Because as consumers, we've been conditioned that the answer to those two questions will determine whether or not we're getting a good deal. What is really important to remember is that the all-in-one loan is rate tolerant. That means it's going to perform for you in a high rate environment and it's going to perform for you in a low rate environment. Why? Interest rate matters least. I'm not saying it doesn't matter. Obviously it does. But emotionally speaking and mathematically speaking, interest rate matters least. What matters most in a principal paid first product is you as a consumer putting your money to work for you. In fact, using your own money is a better financial hedge than any low interest rate that you can get. And in the all-in-one loan, you've got several options that you can choose from with your loan officer. They're going to range from the 1 month adjustable, which is by far to this date the most popular. But we also have a 5-year fixed and a 3-year fixed with an introductory rate that is just gaining in popularity just due to where we're at in today's economic environment. We do use the 1-year CMT as the index. And even though it's a yearly index, we use it on a monthly fashion. So we're always going to set the index for the month based on the value that was posted by the U.S. federal. We have the website link, but we use the published rate value for the last business day of the previous month to set the index for the following month. So your loan officer has that website. So if you want to track the index, you're more than happy to, or yeah, you're more than welcome to, I should say. The product, the all-in-one loan, index plus margin equals your rate. But what margin are you going to be subjected to? That's going to be a discussion that you have with your loan officer. The margin options that you have are going to depend on the rate term, so 1 month, 3-year, or 5-year. And it's also going to be dependent upon the occupancy type of the property. Is it owner occupied? Is it a second home? Or is it an investment property? Those are things that your loan officer is going to need to know so that they can quote you a rate based on your scenario. Because this is adjustable, we do not let it adjust indefinitely. That wouldn't make sense. So we do have a 6% life cap, which means that the rate will never go higher than 6% above what you initially had it at. That's just the cap, and it's a lifetime cap. So it doesn't have limitations on adjusting during certain months or years. It's just a lifetime cap of 6% above the initial rate. We do have floor rates as well. And if you're unfamiliar with what a floor rate is, that means if you add the margin to the index and it's less than the floor, well, then it's the floor rate that you would be subjected to until the index starts to adjust again. Remember, the margin stays consistent. It's the index that can adjust. And depending on your occupancy type, that's going to determine what your floor rate is. And I would say that the interest rates on the all-in-one loan, when you look at the fully indexed rate, they are absolutely competitive to conventional mortgages and what's out there. Even though they may tend to be slightly higher given the current environment, again, it's rate tolerant. So the product is still going to work for you, even in a high rate environment, because you're putting your money to work for you, reducing the balance by which that interest is calculated. If you'd like to know more about this product, I would absolutely recommend that you reach out to your loan officer to go over our interactive comparison simulator. This is an interactive tool where you enter in information about the scenario, no personal information, by the way. So no name, no phone number, no email address, none of that. Just mathematical information on the loan we're going to compare, your deposits or income versus your spending habits, and then we can tell you how well this product could potentially work for you and your household. There's even the ability to change the rate term and the margin. You can put in lump sum deposits or withdrawals. So it's very interactive. But keep in mind, we return information based on what you provide. So good data in is going to equal good data out. Bad data in is going to equal bad data out. You want to make sure, again, that you're answering the questions accurately. And to do that, I do recommend you go through that with your loan officer, because there are some defaults programmed behind the scenes that as a user, you're just not going to be, it's not going to be intuitive enough to know exactly what's going on. And having your loan officer with you to go through that as an example or with your information is going to be very helpful for you to understand how the product works, especially as it relates to your personal situation or household.